Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ice raw sugar. The weekly key reversal down, now 5 weeks ago, was, though I suspect it probably no longer is, the most significant recent formation here since the double top made over August to September. The reason for its downgrading is simple enough. We have an overall bullish incentive, exemplified by the middle and upper tines, currently 1803 and 2029 respectively, of the December 2020 to April 2021 bullish shift pitchfork, that have overall, with some aberrations, guided the market higher since April. This has, along with on a tactical level, the combination of the April 2021 to date uptrend currently at 1910 and the rising medium moving average currently 1905, guided prices higher and started to erode, since mid-August, the heavy duty overhead resistances we can still see. These resistances are the same overhead resistances that we saw back in that double top in August and ever since. Notably, the heavy congestion from January to February 2017 between 2010 and 21 even, and the upper tine, the broken upper tine of the December 2020 to April 2021 bullish shift pitchfork. Of the two resistances I said last week, that's the former is the stronger, and I still stand by that. Meanwhile, the nearby support below is the same as it has been in September and October and consists of the previously mentioned rising supports plus the February 2021 high at 1894, with now the late September based uptrend currently at 1923 as a new rising wedge type trend line. Last week it seemed the action between the supports and resistances was stabilizing. However, as I mentioned at the time and earlier today in this commentary, with a couple of new factors entering the frame. These are the previously mentioned April to date uptrend and its partner, the rising medium moving average, currently at 1888. 3 weeks ago, the uptrend has crossed up over the 1894 support from below, and it added to what I've said now for a few weeks, and I quote, "This market has what looks like elements of a market being squeezed, but with still plenty of room to maneuver. Just be careful of the downside for the moment." End of quote. That was then and this is now, and I'd add this additional comment. The room for maneuver now is getting significantly, very significantly, less than it was then. Watch out in case it all gets squeezed too much. Ice Europe white sugar. First off, what I once acknowledged many times as being up off the top of the daily chart has now, due to the market's movements, entered the frame on the top right of my daily chart. It was to regard the whole of the September 2020 to date action as a huge possible bull flag for potential topside target X2 in the 560 area. This was, though now may no longer be, a very big ask of the market. However, I qualified it all by pointing out that as other targets have been achieved, it seemed appropriate to keep this one in mind, just in case. Even as recent as last week, I was increasingly minded to look to retire this target, as I thought the market's patterns may have changed enough as to no longer make it valid. Not so this week, as Friday's high was the highest we've seen since March 2017, and now directly threatens the overhead gap from March 2017 between 531.70 and 532.70. Overall, the market continues to nicely move up and around the middle tine, currently at 527.70 of the early August to early September bullish shift pitchfork, something that looked a bit dubious last week. However, I also said last week that, and I quote, "This middle tine has some form as it acted as a rolling higher support in September and 2 weeks ago," and this is now 3 weeks ago, and again last week, which is now 2 weeks ago, as a rolling resistance. Thus, this middle tine can be seen as a market attractor of sorts. There are a couple other features to note. The congestion noted in early 2017 in the 518 area, which acted as a lingering cap on the market, is now broken and turned into support. The other feature is to look at the rising upper trend line of the connected tops from August to October, currently at 539.40. This is the next significant resistance overhead. beyond the March 2017 gap. I said last week that this trend line intimated that we may have the beginnings of a possible rising wedge pattern or a possible bull channel. However, the lower trend line for this is still obscure, and the best I can give for this is the rising short medium moving average, currently 505.30. But even this one is just a suspicion and not necessarily one I would be wedded to. Anyway, the market is generally moving up along this middle tine for the moment, so until it decides it doesn't wish to anymore, that is a thing to watch. So far it has been a pretty good indicator of the bullish angle of attack of this market. Now, one final postscript for today's action. Currently this looks like a hanging man pattern for today. Now, hanging man patterns are traditionally seen as bearish reversals. However, data indicates about 6 out of 10 times they act as a bullish continuation pattern. The question is whether the market will follow tradition or data on this pattern. There is also one other point on today's action. If we close tonight over 527.30, then today could also be seen as a key reversal up, if only just. More on this to ponder, methinks. White sugar premium spread. This to me is by far the most interesting of the sugar charts this week. I'll explain what I mean. Now, 4 weeks ago we had a bearish dark cloud cover pattern. This was followed 3 weeks ago by an immediate countering bullish double. This was then followed 2 weeks ago by a counter to the counter key reversal down and bearish engulfing pattern. Then last week we had a third countering key reversal up and bullish engulfing pattern. In all that time the ranges have become wider, but what is most obvious from all this action is that this market is hugely indecisive. Not just on an intraday basis or an interday level, but on an interweek level. The one feature in all this that has managed to maintain its integrity has been the middle tine, currently 68.25, of the broken big bearish May 2020 to February 2021 bearish shift pitchfork. And that's as a falling but still solid support. All the moving averages, bar perhaps the short medium moving average, currently at 72.75, even the 50% Fibonacci lines at 82.75 and 80.25, all these have fallen to the wayside compared to this bearish pitchfork's middle tine. We now need to look at the upper tine, currently at 96.5, as perhaps, just perhaps, providing some significant overhead resistance going forward. This week we're seeing prices start to already move higher towards that overhead resistance. It will be interesting to see firstly if they meet, and secondly what happens. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.